Hello everyone, welcome to your retirement newsletter for Friday. Today is May 27th. I will not be using my normal video camera, just the webcam here, so I'll probably be cutting myself out really soon. But I wanted to talk today about 5 articles that I found that are really interesting and kind of will help you look into your own retirement plans as far as like 401ks, also a little bit about Social Security, perhaps getting a larger cost of living adjustment, the COLA for 2023. Small report about Robo Advisory and which ones did best, and a little bit more about annuities and how, if you have an income option in your 401k, it might be better to actually transfer those assets out into an individual annuity product, simply because annuities are state regulated, and most companies who run large 401ks are federally regulated with the SEC. That basically means that they look at federal regulations, federal guidelines, and federal products, not state regulated insurance products that annuities are. So let's go take a look first at 401k. So in this article, they talk about how 401ks have different kind of non-transparent agreements with the actual fund within the 401k. So you can kind of look at it as, even though 401ks have really low fees, still, when you compare it to potentially managing the fee or managing the assets on your own, you could still be paying a whole lot, simply because 401ks have a revenue sharing agreement with a lot of the funds that are within the 401k. And with the 401k, the plan administrator, they are the ones that decide what funds are put into said plan, and many times their decisions are influenced by the revenue sharing agreement that these different funds have. I myself have been a part of 401k management, selling the entire bundle, but the plans that I dealt with never really paid out a revenue sharing agreement. That was an additional cost that the actual plan administrator, for example, if you have a Fidelity 401k, I would be compensated based on the 401k agreement for advisory. Then the actual Fidelity would be compensated based on the plan or the funds that they would include. Sometimes, a lot of times, Fidelity would also be the third party administrator and actually go ahead and share the revenue kind of internally in their departments. But if there's a separate third party administrator, that third party administrator could pick and choose the 401k Fidelity available options for investment, and then I myself would only be able to choose from within that basket of investments that the plan administrator, the third party administrator, in this case Fidelity, would be selecting for me to choose from. And that's where they're saying this revenue sharing affects the fees in the 401k menu design, because as a financial advisor, when dealing with these plans, we don't actually get to design the plans most times, at least in my experience. Many financial planners, I would assume, do, I would hope do, but as I said, I'm no longer in this industry, so not really able to comment any further. But if you do have a 401k, consider rolling it over into a traditional IRA and take a little bit more, I guess, of a hands-on kind of a attempt to managing your money. Many of the funds or 401k kind of management are basically index funds anyway. So if you buy like a lot of index funds anyway, then potentially just rolling it over to the IRA section of, if you have a Fidelity 401k or a Vanguard 401k, might save you in some fees and also give you a little bit more insight into how your money is actually going. I heard this really recently. In fact, I think it was this morning, that we spend all this time saving up all this money, yet we don't spend any time on figuring out what to do with our saved money. So folks saved a whole lot of money, hopefully, in your retirement, your path to retirement. Look into a little bit about managing that money responsibly. A lot of people nowadays have free access to education online through the broker or through the investment company that they're working through. You don't have to do what I do and go get a college degree in finance and purchase and subscribe and buy all these high level technical analysis and finance books. I mean, a lot of information that they provide me is just kind of a distilled version where you can get that almost same exact information online for no cost to you. All right, so let's move on and talk about Social Security. So I found this article really, really interesting because it shows here how Social Security falls short currently, right? So we had a 5.9% increase, and if you took the average retiree benefit, that was a benefit increase of $92.30. Now the actual realized consumer price index inflationary was up 7.8 from December, or over the whole year, right? Annually. So we didn't even beat our last year actual inflation, and it keeps going up. The year over year inflationary increase keeps rising. Well, we did see a little downtick here, but it's going up, and it definitely is not enough with just 5.9%. So could we see a 10% increase in Social Security benefits next year? We don't know, but what we do know is that Social Security is falling short, and based on this study here from the Senior Citizens League, from January 2000 to March 2022, the cost of living adjustment has been 64%, but the actual cost of goods have been a whopping 130%. So that means for every $100 a retiree household spent on groceries in 2000, today they can only buy about $60 worth of that same amount of groceries. So they're losing a lot of buying power, even with the Social Security cost of living adjustment being what most people would consider high at 5.9%. So even more so, every penny counts. And in regards to like your 401k and fees and things like that, if you still have a 401k, reach out to someone you trust, and then have them maybe refer you to their advisor, do some research online, find a good brokerage or advisory firm to transition to, see if they can do just not manage your money, but have your money there. There's a big difference. For example, I used to charge up 50 basis points to 1% to manage assets, and that eats away at your your overall funds. With a 401k, they still eat away at your funds, but you don't get the one-on-one attention. And if you can manage it all by yourself, you can avoid that whole advisory fee, what I used to charge folks, and just manage it yourself, if that means more to you. Because I want to say that it doesn't, having an advisor is not necessary. It helps when you can contact somebody to go through what's going on, maybe to handle paperwork. But if you can handle the paperwork, digest what's going on in the marketplace to the degree that you want to understand it, you don't really need an advisor. Sorry, advisors out there. Next, SEC charges Allianz Global with multi-billion-dollar fraud targeted at pension funds. So basically what happened here is, this is not to the regular consumer, but this is something that can happen. Many times when you're picking your own fund, you're going to look at these wonderful sharp ratios and all these types of financial projections and analysis and spreadsheets and things. And what Allianz Global did was they actually under I guess stated the amount of risk that their fund took on. And during the pandemic, that really hurt their fund. Their fund lost 40% or something, which they shouldn't do, because pension funds typically need stable income or stable kind of returns, because pension funds have to pay out a stated benefit every month, every year, so they can't afford fluctuations. They are more concerned with keeping their return rate stable. a lot of fixed income funds, alternative funds, kind of risk allocation funds use a lot of derivatives. And derivatives can be used really securely, really easy, because you can see how much risk you are actually taking. The risk that you have a lot of times with these like option contracts are, you can easily see them. Now you can take positions where you're at an unlimited risk, and I feel like maybe Allianz might have taken some of these more riskier positions and not accounting for outlier risk, which is something that many of these risk allocation funds are actually supposed to position against. Outlier risk. The main strategy that I use to manage my own retirement is an outlier risk type strategy, where it will not make any crazy adjustments until we reach an outlier event, and then it will start to kind of mobilize itself. But until then, we keep in normal distribution. What this fund does, or did potentially, is have outlier risk being basically uncontrollable. And like I said, I don't know what the actual allegations are. It's still currently being pursued in I guess courts, but just know that when you pick your own fund, if the numbers look too good to be true, it probably is. There's no magic anything in the marketplace. No one fund manager knows more than the other fund manager usually, unless you have like a private equity type deal where you're kind of investing in things that are not publicly traded. But for everything that's publicly traded on the stock market, everybody has the information. You can have all the information that all these other fund managers have, and it's just their interpretation of the data, plus their interpretation of the macroeconomics, plus the interpretation of everyone else, because it's a supply and demand marketplace. If enough people believe XYZ stock is gonna hit $100 and it's only $50 today, it will get reasonably close to that $100. If barely anybody believes that this stock is going to be $100, better believe it's going to stay at 50, right? That's kind of how supply and demand works. And then once new information is received, the stock's reaction is pretty much instant. There's no real unknown or known unknowns out there for the stock market, other than we all know what we know, and we all don't know what we don't know until it becomes in line. And that's how you kind of manage the stock market. And expectations is mainly in the short term. In the long term, normally, if you look at a chart of the S&P 500, we're going up still. We're still going up. We still haven't gotten below our COVID-19 lows. So we're still technically in an uptrend for the past, many years. Next one is Robo Report. So I'm just going to skip to the very end here. And they said that the top year-to-date performers was Wealthfront, Morgan Stanley Inflation Conscious, and Personal Capital for the total portfolio of kind of solutions or products. For equity, Wealthfront, Interactive Advisors, then Schwab, Domestic Focus. Fixed income was Zacks Advantage, Personal Capital, and Marcus Invest Smart Beta. That's for the year to date. And then this list, as you can see, I'll provide this in the link for this video. But this is kind of where you can see that they have, robo-advisors have performed well, but not all of them. And most of these options to choose from aren't going to be your super like 20% on the year. Last year S&P did like 20-something%, but they're not going to be your super powerful funds. They're just kind of your set it and forget it funds. That's what robo advisors typically do. It means it's a passive fund, and you're not really doing too much with it. Let's see, so these are the total portfolio kind of performance of all those, or at least a high amount of those that are in the robo space. Yeah, kind of very big names like Schwab, TD Ameritrade, Marcus, they are actually a subsidiary of Goldman Sachs, JP Morgan Chase, Merrill Lynch, Morgan Stanley, so E-Trade. So a lot of these companies are, have robo advisory options, and you can see the overall performance on all of them. Again, choosing if you wanted to choose your own kind of investment strategy. And the last thing I'm going to talk about is annuities. So annuities, because of the way that the 401k kind of works, it is an SEC ERISA managed, regulated tool, right? It is a 401k retirement plan, and the investments inside the plan are supposed to be investments. An annuity, on the opposite end of the spectrum, is considered insurance. And an annuity is very different from a security. A security is regulated by the SEC. Annuities are not. Annuities are made to be a form of guaranteed income for the rest of your life. That's pretty much the use of annuities within the retirement planning process. You can front load it, put money in an annuity today, and hopefully it builds up so that when you turn on that unlimited stream of income, that notional value of the income is higher than if you were just to start with that amount of money today. And what it's going to require now is that the fiduciaries of the 401k plans are going to have to learn about all the different annuities available in the states that they operate their 401k plan in order to be a true fiduciary, because 401k plan administrators are fiduciaries. Advisors on the plan merely advise on the plan administrator's choices of investments that the plan administrator and usually it's the fiduciary decide on. So I'm usually saved, I was saved from this kind of conversations, because I don't have to worry about anything on the fiduciary side of plan administration. Now, as a fiduciary myself, when I take on a financial planning client, or when I used to take on a financial planning client, that's different. But for the plan itself, we were kind of outside, just advising on the funds that are in the plan, if we were the financial advisor on the plan anyway. But what it kind of shows us is that potentially, if you want to choose a lifetime income on or in your 401k, maybe it's a better idea to search outside your 401k, because the actual lifetime benefit on these target date plans that are inside your 401k might not be your best option. They might just be the only option. That's usually what it is. They are the only option available. So try and make sure that when you are looking at the various options of your 401k plan, hang on, I'm trying to get my mouse here, then try to again, contact someone you trust, someone so that you are able to kind of be more, I guess, alerted to who and what is available and who can help you. So I'm just looking at the S&P right now. We're just chopping along. Yeah, looks like we're chopping along. Yeah, we can't get over the 1250 level. That's good. All right, sorry about that. Anyway, so that's kind of the article says here. So as I said, to sum everything up that I talked about today, is look at your 401k. If you still have money in your 401k and you're retired, consider managing it yourself, because that's essentially what you are doing inside a 401k, except when you leave the 401k, you may save on some fund fees. You have much more options, and that would help you kind of make sure that each retirement penny is going toward your retirement. If you want to hire on a financial advisor to help you manage said monies and accounts, make sure you understand exactly what you're paying for, because as I said before, many times as a financial planner, my main objective was to help you kind of realize your situation, help you understand the risks of your portfolio, help you kind of handle all the paperwork, figure out what, as a sounding board, what the stock market is kind of doing, what's going on, what the firm that I work for is kind of bringing to light of what's going on in their mind narratively in the market. So make sure you are adequately hiring and adequately spending for whatever you need for this kind of retirement planning spending. Next, Social Security. Hopefully it goes up, but it's surely not keeping up with the cost of living that many seniors are experiencing as far as the increases. Make sure when you choose your funds, if it's too good to be true, it probably is. And of course, if you do need help with lifetime income, and you find that lifetime income might be more important than growing your account value, consider looking at annuities, and maybe not the one in your 401k plan. Look for annuities that are, from somebody who is in your area or at least specializes in annuities, and understand that annuities are not like securities or investments. An annuity is an insurance product, and in the insurance product, what the insurance product does is it pays you for the rest of your life based on how much money you have to put in, and also based on demographic characteristics like your age and your gender, and then of course your state, as annuities, like all insurance, are regulated at the state level. You can definitely ask me, I can give you some ideas, but for the most part, if you guys have financial planners who can already help you with those things, talk to them if that's something you are considering. Remember, the market is crazy right now. Best kind of suggestion I can go is to stay put unless you absolutely need your money. Again, for those of you with financial planners, always consult with them first, as your investment and unique situation may be different than mine or someone else who's watching this video. So don't kind of take my words here as advice. They are not. I have my disclaimer down below, but if you're here for this long, thank you for watching. I'll see you guys next week where we post another video. And of course, do check the Medicare Monday video that I'm posting. I'll be posting on Friday, as Monday is a holiday. So there'll be a lot coming out today. We'll see you guys in the next video.